Welcome back, YouTube. In this video, we are going to go over AMD's earnings. We're actually waiting for them to drop. We're going to give you a current price for the stock and update it as earnings flow out here. What are the growth rates going to be? Is AMD dealing with the same thing as Intel, or are they head and shoulders above the competitors? So we're going to break all this down today. If you like this kind of information, make sure you smash the thumbs up, consider subscribing, and let's get into it. So when we go over to tip ranks, we can see here AMD is absolutely loved. 18 buys, 5 hold, 0 sell with an average price target of $91. We get a low of 68 and a high of 200. Substantial differences between the highs and lows in this company. So we can see here that it really comes down to projections, and it's so important to build safety within your analysis and make sure you're getting a good internal rate of return when you're running your analysis. Now, we all know the chip makers are a cyclical business, and it's been kind of an ups and downs depending on what kind of industry they cater to. The PE ratio is sitting at a 47, and AMD is up 3% on the day. Now, I always worry about these everything rally type moves here because it does cause a lot of FOMO and it causes people to really overspend on a stock. When we scroll down here, we could see that by Yahoo standards, AMD is overvalued roughly 21%. When we take a look at analyst expectation, we can see here that in 2023, it looks like sales are going to slow down, going from 44% growth down to 6%, and then picking back up to double-digit growth going forward until 2026. This is obviously a company having tremendous top-line growth, going from $6.7 billion in top-line revenue in 2019 to going to nearly $23 billion in the trailing 12-month. Along with that, cash and cash equivalents are growing nicely. When we line that up with total debt, very clean balance sheet overall. I like what I see. One thing we can point out here is there is some share dilution going on, but nothing too outrageous at this point in time. Definitely just a slight premium, nothing too outrageous here. The EV to EBITDA on the forward-looking statements here is trading at a 15 when the industry standard is at a 13, and in the trailing 12-month is trading at a 21, is trading at 20.5 when the industry standard is sitting at 14. So I'm going to use a 16 multiple here. If we're looking to get a compounded rate of return of roughly 12%, so we're going to bump it up to 17% growth rates. The reason why I'm doing that is I'm trying to get 2025 revenue close to $35 billion in revenue. I'm going to err on caution and bring it down roughly $1 billion by 2025, thinking that we are going to head into a slowdown. They are going to be impacted here. And what we see is that I technically need to be buying the stock around $47 to $50 is basically where I would be interested in buying AMD. Does that mean it's going to get down to those prices? No, that just means in order for me to get a double-digit rate of return using these numbers and projecting it out over the next 8 years, I technically need to be buying it at $47. And by 2030, the stock will be worth about $110. And that's where I get my internal rate of return of 12%. Now, what we're doing right now is we're just waiting for AMD to report earnings and plug in the new numbers. But somebody must know something because AMD is skyrocketing before any news is out, reaching 77.75, 69 cents in EPS, and they beat on sales, top and bottom line beat. So from a GAAP standard, actually not that attractive here. Yes, revenue was up 16%, gross profit was flat, gross margins are down, operating expenses are up 109%, operating income was down 112%. Operating margins were down 28. Now, what I want you guys to pay attention to is the share dilution here. In a 1-year difference, 400 million shares were put on the market, guys. 400 million shares were put on the market. A goodwill charge of $24 billion. So they actually had an operating loss of $1.4 billion. When we look over the last quarter from last year, okay, yes, they did nearly 5.6 billion in revenue, which is very impressive compared to 4.8 billion just a year ago. But the operating income was actually a loss versus a $1.2 billion gain from a year ago. On a per share basis, they're adding back in 19 cents per share on stock-based compensation. They're adding back in acquisition-related costs, and they're adding back in amortization of intangible assets. which is bringing out a positive net income earnings of 69 cents versus a GAAP net income earnings of 1 cent. So this is where the manipulation comes in on GAAP versus non-GAAP accounting. And to look at it from this angle, they're adding back in stock-based compensation, which is significantly more from a year ago. They're adding back in acquisition-related costs, which is significantly higher from a year ago. And look at the amortization here of acquired intangible assets. Significantly higher. And guys, so I updated the numbers with the updated share dilution. I updated the revenue, and I still use a 16 multiplier here, and I basically get a $36 to $40 price target for, and the stock right now is actually skyrocketing. So this is interesting here. I don't find, yes, they beat on revenue. Yes, they beat from an EPS standpoint. The concern is going to be the forward PE. It looks cheap on here, but as we annualized out $2.80 roughly, if they keep up with around a 70 cent per share earning with the amount of diluting that they're doing, comes out to about $2.80 a share. The stock's currently trading around $78, which gives it a roughly a 28 forward PE ratio, which is extremely rich considering that there could be some margin compression taking place and that demand is diminishing and the growth rate could be in question as well. So just a couple things to think about here. And when we compare that valuation with peers, basically peers are trading around a 19 to 20 PE ratio, and they would be trading right around a 25 to 28 PE ratio, which would be a substantial premium to the competitors. So just something to keep in mind. Overall, I thought it was an okay earnings. I think that there's some manipulation with the GAAP and non-GAAP side of the accounting. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.